The investment thesis for Dundee Precious Metals Inc., DPM, a Canadian-based international gold mining company, centers on a successful corporate transition from a highly efficient regional producer to a scaled, diversified mid-tier entity. DPM's strategy is built upon leveraging its exceptional financial stability, characterized by record cash flow and a debt-free balance sheet, to aggressively fund a pipeline of high-quality organic and inorganic growth projects. The market has begun to acknowledge this performance, reflected in the company's impressive 561.51% total shareholder return over the past 3 years. However, a detailed valuation analysis suggests that a significant discount to intrinsic value persists, offering substantial potential for future re-rating. DPM's asset base and growth mandate. DPM's asset portfolio is strategically anchored by 2 operational mines in Bulgaria, the Chelopech gold, copper, and silver mine and the Ada Tepe gold mine. This productive base is augmented by a rapidly advancing development portfolio, including the recently acquired Vareš operation in Bosnia, the high-grade Choka Rakita gold project in Serbia, and the Loma Larga project in Ecuador. The strategic objective is to become a premier mid-tier precious metals company by utilizing cash generated from current low-cost operations to fund this expansion. The management team's commitment to this transition is evident in the scale of capital deployment. The substantial investment in the Adriatic acquisition, combined with the commitment to fund the initial capital expenditure of the Choka Rakita project, confirms a definitive shift from merely optimizing existing assets to executing high-impact growth initiatives. This expansionist approach transforms DPM from a focused regional operator into a dynamic, internationally diversified growth story. Multi-metal exposure as a de-risking strategy. A key characteristic of DPM's operational profile is its exposure to multiple commodities, which inherently strengthens the quality of its asset base. While gold remains the primary focus, the Chelopech mine is a major contributor of copper, producing 7.8 million pounds in Q3 2025, and the Vareš acquisition adds substantial silver, lead, and zinc production. This multi-metal diversification provides a natural hedge against cyclical volatility in the gold market, ensuring the company is well-positioned to capture the strong structural demand and bullish price forecasts for base metals like copper. Financial resilience and capital structure. DPM's highly conservative and resilient capital structure is a distinctive competitive advantage in the capital-intensive mining sector. Exceptional liquidity and debt management. The company maintains a pristine balance sheet, reporting a consolidated cash position of $414 million at the end of the third quarter of 2025. Crucially, DPM retains net zero debt, isolating it from macroeconomic risks such as interest rate fluctuations. This strong liquidity profile is further underpinned by an available $150 million undrawn revolving credit facility. The financial discipline demonstrated during the strategic Adriatic acquisition is notable. Although the transaction required the deployment of $400 million in cash, management immediately allocated an additional $136 million to retire the acquired debt. This immediate deleveraging of the newly integrated asset minimized acquisition financial risk and maximized the asset's potential for future free cash flow generation. By preventing dilution and maintaining a net cash position, DPM positions itself to withstand unforeseen external pressures, such as commodity price declines or project cost overruns, more effectively than highly leveraged competitors.
Record cash flow generation and growth funding capacity. DPM's operational performance translates directly into exceptional cash flow generation, which fully supports its capital-intensive growth initiatives. The third quarter of 2025 delivered record financial results, including actual revenue of $372.35 million and adjusted net earnings of $129 million, equating to 0.73 cents per share. Most significantly, the company achieved a record free cash flow generation of $148 million in the quarter, an acceleration from the $94.5 million generated in the second quarter of 2025. This internally generated cash flow stream provides the basis for a self-funding growth model. The high volume of free cash flow, when weighed against the minimal sustaining capital expenditures of only $9 million reported in Q3 2025, confirms that the core operational base is a robust engine capable of funding major growth projects, such as the $379 million initial capital expenditure planned for Čoka Rakita, without relying on external financing that could dilute shareholder value. Capital allocation and shareholder returns. DPM demonstrates maturity in its capital allocation, balancing aggressive growth investment with significant returns to shareholders. In the third quarter of 2025, $137 million was returned to shareholders via dividends and share buybacks. This followed a first half of the year where $129.9 million, representing approximately 75% of free cash flow, was returned. This consistent discipline ensures that shareholders benefit directly from the company's strong financial performance, while strategic growth initiatives are simultaneously executed. III, Operational Review, Low-Cost Production Base and Margin Structure. The Margin Anchor, Chelopech and Ada Tepe. DPM's low-cost operational base provides the foundation for its investment appeal. Consolidated production for the third quarter of 2025 amounted to 64,000 ounces of gold and 7.8 million pounds of copper. The Chelopech mine is the primary engine of corporate profitability, consistently exhibiting low-cost reliability. In Q3 2025, Chelopech produced 44,000 ounces of gold and 7.8 million pounds of copper. The mine's efficiency is evidenced by its low cash costs of $63 per ton of ore processed. Critically, Chelopech achieved an exceptional all-in sustaining cost of just $671 per ounce of gold sold in Q3 2025. The Ada Tepe mine complements Chelopech, contributing stable, low-cost gold production, and the company remains on track to meet its 2025 guidance for Ada Tepe of 65,000 to 80,000 ounces of gold. Cost profile and margin capture analysis. The company's high margin profile is clearly visible when comparing costs against realized prices. DPM reported an average realized gold price of $3,635 per ounce during Q3 2025. Measured against Chelopech's AISC of $671 per ounce, the mine realized a gross operating margin exceeding $2,960 per ounce.
While the consolidated AISC for Q3 2025 was reported at $1,168 per ounce, this figure represents a significant increase over the core Chelopech operation. Management anticipates a reversion to lower costs, maintaining a full-year 2025 consolidated AISC guidance between $780 and $900 per ounce. The temporary spike to $1,168 per ounce likely reflects non-recurring costs associated with the Vareš acquisition integration or specific development costs being expensed. A swift return to the lower guidance range is essential to demonstrate that the core operating efficiency can rapidly overcome transitory expenses. The significant volume of copper production, 7.8 million pounds in Q3 2025, is intrinsically linked to the favorable cost base. The resulting high co-product credits derived from copper sales play a pivotal role in reducing the effective net gold AISC. Given the prevailing bullish forecasts for copper prices, the value derived from Chelopech's copper is expected to provide substantial revenue credits, which serve as a powerful financial buffer against potential gold price volatility and ensure sustained margin integrity. The management team's track record of consistently delivering production in line with guidance substantially lowers the perceived execution risk associated with the development pipeline. The established capability to manage complex operations effectively provides confidence that the technical challenges of ramping up Vareš and constructing Čoka Rakita will be navigated competently. Growth pipeline, catalysts for production expansion. The execution of the growth pipeline will fundamentally determine DPM's ability to achieve mid-tier status and realize its valuation potential. Vareš, immediate accretion and diversification. The Vareš operation, acquired as part of the Adriatic Metals transaction, serves as the near-term catalyst for production volume increase. The integration process is advancing, with the target set for an 850,000 tons per annum production ramp-up by the end of 2026. Management has communicated expectations for higher production and grades than projected in the initial pre-feasibility study. This acquisition immediately diversifies DPM's geographical footprint and introduces multi-metal exposure, including silver, lead, and zinc. By pairing Vareš with the Čoka Rakita project, DPM is effectively establishing a consolidated, large-scale growth platform across the emerging Balkans mining region.
The strong initial performance indicators from Verish suggest the acquisition was strategically sound and immediately accreted, justified the capital deployed. Choka Rakita, high-grade, transformative growth. The Choka Rakita gold project in Serbia represents the most valuable component of DPM's organic growth strategy, set to fundamentally transform the company's scale and cost profile. The project, planned as a high-grade underground operation, is advancing its feasibility study, which is targeted for completion by the end of 2025. The quality of the Choka Rakita resource is exceptionally high. Proven and probable mineral reserves stand at 6.6 million tons, containing 1.36 million ounces of gold at an impressive average grade of 6.38 grams per ton. The project is designed with a 10-year life of mine and is expected to produce 170,000 ounces of gold annually during its first 5 years of operation. The initial capital expenditure for development is estimated at $379 million, a cost that the company can readily finance internally given its strong liquidity.
While the project's reserves have been approved, the permitting timeline has experienced a minor pushback of 4 to 6 months, shifting the completion target to early 2027. Despite this, construction is anticipated to begin in mid-2026, targeting first concentrate production in 2028. The high grade of 6.38 grams per ton is globally competitive, and the expected 170,000 ounces of annual production will materially elevate DPM's corporate average production grade, guaranteeing a significant increase in high-margin cash flow that outweighs the impact of a small permitting delay. Further upside is indicated by positive exploration results in the region, such as those at Dimitra Potok, where high-grade intercepts, including 132 meters grading approximately 3.9% copper, suggest the potential for district-scale expansion. This exploration success has justified an increase in the 2025 exploration guidance to a range between $49 million and $54 million. Loma Larga, optionality and risk management in Ecuador. The Loma Larga gold project in Ecuador provides long-term optionality but is currently hampered by regulatory uncertainty. Although DPM successfully secured the environmental license in the second quarter of 2025, the subsequent revocation of that license has forced the company to temporarily minimize spending. The 2025 growth capital expenditure guidance for Loma Larga remains at the original lower range of $12 million to $14 million, with management planning to minimize further spending until the regulatory issue is definitively resolved. This approach of limiting capital exposure is a display of prudent risk management. By treating Loma Larga as a low-cost long-term option, DPM protects capital from potential geopolitical write-downs while continuing critical technical work, including a planned 23,000-meter drilling campaign in the second half of 2025. This ensures the asset is sufficiently de-risked and ready for immediate acceleration should the regulatory and political environment in Ecuador become favorable. External factors, commodity market outlook. DPM's highly efficient production base is strategically leveraged to exceptionally favorable price outlooks across both the precious and base metals complexes. The gold price trajectory. Analyst consensus points to substantial continued upside for gold prices. J.P. Morgan Chase projects gold prices could reach $5,000 per ounce by the fourth quarter of 2026, while Goldman Sachs anticipates a target price of $4,900 per ounce by the end of 2026. Other institutions, such as TD Securities, forecast a new high of $4,400 per ounce in the first half of 2026. These bullish forecasts are grounded in significant structural drivers. Key factors include sustained high-volume gold buying by central banks, growing market concern over large global fiscal deficits, expected declines in U.S. real interest rates, and continuous support from geopolitical risks. Given DPM's high average realized gold price of $3,635 per ounce in Q3 2025 and its extremely low operational cost base, $671 per ounce AISC at Chelopech, the company is positioned to capture maximum incremental margin as the spot price climbs toward these institutional forecasts. Copper's structural demand tailwind. The outlook for copper, a material revenue component for DPM, is defined by structural tightness. Demand is being driven by the global transition to clean energy, large-scale electrification initiatives, and emerging requirements from the data center industry. Market forecasts reflect this fundamental strength, with 2026 price projections ranging from $10,000 per ton, Goldman Sachs, to an optimistic $12,780 per ton, Morgan Stanley. Copper has already notched recent highs, with 3-month contracts in London reaching $11,952 per metric ton. UBS projects global copper consumption growth of 2.8% in both 2025 and 2026. The long-term anticipated structural shortage, expected to materialize fully by 2029, assures sustained high-price support for copper, directly benefiting DPM's operational cost profile through increased co-product credits. DPM benefits from this dual commodity upside, offering investors a balanced hedge against market fluctuations. This positioning allows the company to secure premium returns from both the safe haven properties of gold and the secular growth trends underpinning copper, ensuring highly productive cash flow generation regardless of which commodity cycle leads the market. Furthermore, the enhanced cash flow resulting from these high commodity prices acts as a powerful financial buffer, effectively mitigating the financial risk associated with project delays or potential capex overruns on the growth pipeline. Valuation, analyst consensus, and peer comparison. Persistent valuation discount. A fundamental driver of the DPM investment case is the substantial valuation discount relative to both the broader gold industry and its mid-tier peers. DPM currently trades at a price-to-earnings PE ratio of 23.67 and, more instructively, a price-to-cash P/cash multiple of 2.79. When comparing these multiples to the gold industry averages, a PE of 41.51 and an average P/cash of 22.12, DPM appears severely mispriced relative to its cash flow productivity and operational quality. This gap is further evidenced when comparing DPM to key mid-tier peers such as Alamos Gold or Pan American Silver, which trade at PE ratios in the mid to high 30s. This divergence suggests the market has not yet fully capitalized the value of the company's zero debt structure, its industry-leading low costs, $671 per ounce AISC, and the immediate production scaling from Vareš and Čoka Rakita. Analyst sentiment and divergent price targets. Institutional sentiment regarding DPM is overwhelmingly positive, with the analyst consensus rating standing at a strong buy. This consensus is derived from 11 analysts recommending a buy rating and only one recommending a hold. The stock has generated strong analyst interest, with 5 research reports published in the previous 90 days. However, the consensus price targets reflect a degree of tension regarding the discounting of future growth risk. While one source indicates a potential upside of 12.1% based on the average price target, an alternative dataset reports an average price target of C37.86, suggesting an 8.1% downside from recent trading levels. This disparity highlights that the core variable in DPM's valuation is the discount rate applied to its future production. The full range of published targets spans from a low of C23.75 to a high of C50. Analysts assigning lower targets are likely applying a heavier penalty for the execution delays at Čoka Rakita and the regulatory uncertainty at Loma Larga. Conversely, those assigning higher targets are capitalizing the intrinsic value of the high-grade Serbian asset, 6.38 grams per ton reserves, and the security of the debt-free balance sheet. The stock's ultimate re-rating will be directly correlated with the successful de-risking of its growth milestones.
Investment risks and mitigation strategies. Geopolitical and permitting volatility. DPM operates across several jurisdictions, which offers diversification but necessitates careful risk management. While Bulgaria provides a stable operating history established since 2004, the shift toward higher growth assets in Serbia and Bosnia introduces increased regulatory complexity. The current delay of 4 to 6 months in the permitting timeline for Čoka Rakita underscores the inherent volatility in emerging mining jurisdictions. The highest political risk exposure is currently centered on the Loma Larga project in Ecuador. The revocation of the environmental license demonstrates the potential for severe regulatory reversal, requiring DPM to treat the asset as an optionality play by minimizing capital expenditure until the legal environment stabilizes. This strategy of trading low-risk, lower-growth stability for calculated higher-risk, high-return potential confirms a sophisticated approach to capital allocation aimed at achieving the company's mid-tier scale mandate. Conclusion. Dundee Precious Metals Inc. presents an investment opportunity with a clearly defined high-quality growth trajectory. The company possesses an almost unmatched financial capacity, evidenced by its net zero debt position, $414 million cash balance, and industry-leading cash flow generation, $148 million FCF Q3 2025. This financial strength allows DPM to internally fund its multi-asset expansion strategy. The company is strategically positioned to benefit from 2 powerful commodity tailwinds. High realized gold prices leverage its extremely low-cost operational base, $671 per ounce AISC at Chelopech, while significant copper production captures the robust structural demand from global electrification. The future value is anchored by the high-grade Čoka Rakita project, which, despite minor permitting delays, is expected to deliver a transformative scale of production, 170,000 ounces per year. The analysis confirms a substantial discount in the company's valuation multiples, especially the price-to-cash ratio, compared to sector averages. This discount is primarily a reflection of market risk aversion toward the execution timing of its growth projects. However, DPM's proven management track record significantly mitigate these execution risks. A material re-rating is anticipated as the Vareš acquisition demonstrates operational success in 2026 and as the Čoka Rakita project de-risks toward its anticipated 2028 production start, translating its 1.36 million ounces of high-grade reserves into realized share
shareholder value. Investors should view temporary permitting setbacks as opportunities to accumulate equity ahead of these definitive production catalysts.